Hello, my fellow investors, and welcome back to another viewer-requested fundamental analysis video. Guys, we have another one of these videos because, well, you guys see, there's still no earnings for this week. Really, the only thing that we're really looking forward to is, of course, CPI, which will be on Wednesday. So, with that said, let's actually spin the wheel and let's see what company we should analyze today. Now, if I remember, we did get last time Tony's stock of SMPL, so this time we are going to get STNE. All right, now STNE was brought up by none other than Brett. Shout out to Brett. Here's the comment. And let's take a look at this company, guys. Let's take a look at, obviously, the website. Let's take a look at what they do. Take a look at their overall charts, dividends, that kind of stuff, earnings summary at least. Then take a look at their fundamentals, and let's do this kind of free cash to see if whether or not this company is a good buy at the current moment. But before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as remote. Make sure to follow us on X at Fatal Investing. If you'd like to join us on the Discord, the link is in the description below. So with that said, let's get started with this video. All right, everybody. So here we have the company StoneCo, which I don't know anything about this company. It's a financials company, but I really am curious to see what in the world they do. So let's jump into their company profile. We got StoneCo Ltd. Financially provides financial technology and software solutions to merchants and integrated partners to conduct electronic commerce across in-store, online, and mobile channels in Brazil. Wow. Okay, this is interesting. It distributes its solutions principally through proprietary Stone hubs, which offer hyper-local sales and services, and sells solutions to brick-and-mortar and digital merchants through sales teams. Okay, the company served small and medium-sized businesses, which we love to see, and marketplaces, e-commerce platforms, and integrated software vendors. StoneCo Ltd. was founded in 2000, so it's about 24 years old now, in Georgetown, the Cayman Islands. Wow. Okay, this is a really interesting one. And I said it was financials, but by the looks of it, yeah, they're mainly like a PayPal kind of thing, right? Not entirely, right? But it's transaction and payment processing services. So it seems to be more of like, I don't know, like a Salesforce kind of thing. At least that's what I'm kind of attributing here. Still, though, really interesting. No employees mentioned, but that's probably because it's a foreign company. Again, guys, Cayman Islands, that's quite an interesting location as a headquarters. Really interesting. So now looking into their earnings, gotta say, company like this, you're not going to get too much excitement with it, right? It's foreign. You don't really have a lot of eyes on it. Maybe a good price to buy that, guys. I'm not joking you. It might be actually a good price to buy at. On August 14th, they had earnings. EPS normalized actual of 29 cents, beats by 2 cents. EPS gap actual 29 cents, beats by 3 cents. And revenue of $586.23 million, beats by $22.11 million. And for the next one, it's going to be on November 15th. EPS normalized estimate coming in at 32 cents. Gap estimate 31 cents, and revenue of $602.11 million. And 8 total revisions, 5 of them to the upside, 3 of them to the downside. Alrighty, so let's jump right into, guys, the calculator. Now, full disclosure, we have to use the 5-year summary because this company is off by 2 years, so that way we could actually use the 10-year one. So just to be safe, let's use the 5-year one. So just so you know, that's essentially what I'm doing here. Looking at the ticker, we got STNE, market cap of $3.55 billion with a PE of 10.27. Honestly, it's not looking too shabby right now, at least from what this is showing on the PE basis, with a current share price of $11.29. And looking at this stock on the 1 year, this is down 3.26%. On the year to date, guys, wow, that's a lot. Wow, that's a lot. 37.99, essentially 38%. Absolutely massive. 52-week high of $19.46 to a low of $9.34. Those numbers are actually kind of nuts because I already took a look at the discounted free cash flow part of it, and it's kind of crazy. So yeah, it's near that 52-week low, and actually I'm very curious. Wow. Okay, so this thing was definitely a hype company. Yeah. Oh yeah. Yep. This was definitely one of those memes. I don't want to say a meme because I don't know about this company too well back in like 2021. But by the looks of it, man, this does have the smell I guess you could say, of a meme company back in like 2021 where everything was just up, 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 up. Stocks can't go wrong, stocks can't go low. And recent all-time highs, guys, of $92. $92. Oh my goodness. So I already know what this kind of free cash flow actually says. Wait until you guys see it, because I'm going to prove once again with another company that every investment is the present value of all future cash flow, and you can absolutely overpay for something. So let's continue on with this. Taking a look further, we can see that they don't pay out a dividend, which means all of the free cash flow is going straight into themselves. And gotta say, the free cash flow is actually not looking too bad. $15.32 million on the 5-year average. As of the last year's free cash flow, it is $188 million. Not too bad at all. And now looking at the fundamentals, starting with the net income, we got 5 years ago of $199.8 million to 1 year ago of $328.2 million. Now, we can see here that, yeah, this was negative 3 and 2 years ago. So 2023, 2022, 2021, 2020. So I look at this and I'm like, well, clearly they were affected by COVID the following year. However, they did recover, and they did recover nicely. This is an increase of 64% on the 5-year. I'm going to have to say, guys, I'm going to have to say like a 60% when it comes to this one. Looking at the free cash flow, dear Lord, negative $742.7 million to 1 year ago of $188 million, increase of 125% with an average of $15.32 million. Let me tell you all right now, this is mainly due to the cash from operations going in the negatives. And here is the proof. Basically, from 2016 all the way up to 2019, negative, negative, negative. In fact, actually getting worse into the negative. Then out of nowhere in 2020, they just went into positive, positive, positive. And then as of today, trailing negative $633.6 million. Bro, this is all over the place. I'm going to have to say a little, I was going to say 50, but in reality, it's more like a 20%, guys. It's not that good at all. Looking now into the revenue does look very, very nice. We can see here that 5 years ago, it was $594.5 million to 1 year ago of $2.34 billion, increase of 294%. I'm going to say, guys, that this is an easy, I'm going to say 95%. I would give it 100, but it's a little bit steep, especially 3 to 2, so 95% when it comes to the revenue. Looking now at the total assets minus total liabilities, consistent, increasing, right? Also increasing, consistent and increasing. Average total assets of $8.2 billion. Ooh, liabilities of $5.52 billion. That is a difference of $2.71 billion. I'm going to have to say, guys, for the assets and liabilities, I'm going to say like a 60%. I don't like the fact that the liabilities are that much, but it's still looking okay, right? It's still looking okay. Looking now at the cash flow minus the liabilities, ever since 4 years ago, this is decreasing and decreasing hard. I mean, as of 1 year ago, it is negative $6.8 billion. The average being negative $4.8 billion. Oof. I'm going to give this like a 5%, honestly. Really, really bad. Consistently decreasing from 4 to 1 year ago. One instance where they slightly went up 5 to 4, but aside from that, really isn't telling me much here. 5%. Now, taking a look at the shares outstanding, this one is also, it's weird. It's weird because they increase it, but they also have tendencies to decrease it as well. Going from 5 years ago of 277.4 million shares to today of 306.3 million shares. There's an issuing of 10.42%. Previous year to the current year, that is a buyback of 0.84%. So I look at this, guys, and I'm just like, okay. I'm going to have to say a 70% because we can see that it's not just an all-out issuing, right? They do have their instances of buying back like 2 to 1 year ago, and even 1 year ago to today, they are buying back. But at the same time, it's like, I don't know where it's going. So you know what? Nah, I'm actually going to give this a little bit higher. I do like this. It's an 80%, right? I'm going to say an 80%. And lastly, cash and equivalents, they currently hold $848.5 million with an average of $517 million. Overall grade for this guy is a 55%. Yeah, it's slightly better than, I guess, average or half, right? Slightly better than, I guess, half. Main issue that I find is it's the free cash flow, right? The free cash flow is by far the worst thing in this whole entire thing, which, well, it's the one that carries the most weight for me, right? Because cash flow is used for everything. So yeah, I don't like this as a fundamentally, I guess, good company. Not saying that it doesn't have potential, but you would have to do a lot more research. For me, just looking at this on like the 10,000 foot view, it's not something that I would do. But if you guys do want to do it, let's actually take a look at now the discounted free cash flow to see if $92 was a good price or not, which clearly it wasn't. Alrighty, so here we have the discounted free cash flow, and oh boy, this is not looking good. Guys, not adjusting for debt, we got $1.17, then adjusting for debt, $1.36. So, let's input some of these numbers here. Obviously, because this is the 5-year one, we can actually use the growth assumption based off of seeking alpha, which I completely forgot about because I rarely do this 5-year one anymore. So yeah, I literally just reminded myself as I was saying that previous sentence. But we can see here that the growth rate, at least the revenue growth rate when it comes to the forward of this company, estimated at 14.1%. So let's do that. Let's do 12, 14, and 16% in the next 5 years. Now for the projected share buyback, I think I'm gonna go the pity -1, 0, and 1%, guys. It's stable. I don't think it's that bad. It is so stable. Yeah, I mean, guys, even with these numbers, we got $1.74 to $2.03, and then adjusting for debt, $1.93 to $2.22, margin of safety 5, 10, 15, $1.64 to $2.11. Yeah, it's still massively expensive. Right, so massively expensive. Now, if it was expensive right now, but guess what, guys? If I would have taken a look at this company back in like February of 2021, mid-February of 2021, I would have said the exact same thing. Company's massively overvalued, and a lot of people would have been like, "You don't know what you're talking about. They have so much stuff. You have no idea. This thing will never stop going up." Yikes. I empathize with anybody who actually has lost money on this. If you guys are still holding it from back then, I mean, not financial advice, obviously, because none of this is financial advice. But I would just say, guys, that maybe you should just, I don't know, take the L, right? But that's just me. Not financial advice. Every investment is the present value of all future cash flow. That's why I give the calculators up for free so you guys can make your own financial decisions for yourselves. I'm just here to provide something to guide you, right? Something to guide you. I would have taken a look at this company back in 2021. I would have been like, yeah, no, absolutely not. It's way too overvalued at $11. Way too overvalued. It was way too overvalued at $94. Could have avoided those losses. If you guys are still holding, I don't know. You guys make the decision for yourselves. I would personally just take the L and put that money into somewhere that may be suitable, right? And just be okay with the fact that if this thing just shoot up out of nowhere, well, you know, it is what it is, right? It is what it is. So that's kind of the mentality that you got to have. But hopefully this helped, guys. Again, not financial advice. Every investment is the present value of all future cash flow. So all in all, when it comes to StoneCo, yeah, I don't like this company. I gotta say, it's not there for me, right? It's just not there for me. I don't know what else to say. Could they have potential? Yes, but so does every other company out there. Even a penny stock, which I'm not saying that this is, but I'm saying that even penny stocks have the potential to quadruple X whatever, right? So this is the way that I see it. Fundamentals aren't really proving that. But anyways, guys, that pretty much is it for this video. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube, as well as remember, make sure to follow us on Next Affiliate Investing. If you'd like to join us on the Discord, the link is in the description below. And to anybody who didn't see the Discord chat or the X post, guys, as you're seeing this video, you probably realize that I did not make a stream for CPI Open. I'm so terribly sorry. I had to go into work, but you guys should see a stream pop up at around 7 p.m., right? So we're going to stream 7 p.m., or at least I'm going to stream 7 p.m. to cover CPI today, right? So yeah, be there. We're going to cover CPI. It'll just be me, but it should still be fun. But anyways, guys, that pretty much does it. Peace out, and we'll see you all next time.